Hello everyone, welcome to the Financial Frontier. Today, what I'm going to teach you is how to optimize your portfolio in R. In order to understand the portfolio optimization, we have to first see a couple of examples to get a feel for it. So let's look at a simple two-asset model in R. As you have already downloaded the R, as one of the video in our channel suggests, I ensure that you will not need much help from my side with downloading R, so we can just move on with the explanation. We have several parameter values in the simple model: the return for asset A, the return for asset B, the standard deviation of the return of asset A, and standard deviation of the return of asset B. What rho AB represents is the correlation between the returns of two assets. Here it's set to -1, and when the correlation is set to -1, it means that when returns for one asset are high, at the same time, the returns for other assets are low. All of these commands set the parameter values using this arrow figure. Next command generates a sequence of different weights, and for A and for B, for our potential portfolio. Here it generates it from 0 to 1 with the increment of 0.005. The WB ensures that the weights are inverted for the other asset. Basically, when we hold 5% of one, we hold 95% of the other. This following script calculates the return of the portfolio. It's logical to say that when we have 5% of asset A and when the return on asset A is, say, 6%, we should multiply the weight of asset A by the return on asset A and add the asset B's weight times the return of asset B. So that's what it calculates. We just sum up the returns for both assets weighted by the respective weights of the portfolio. In the following, we compute the standard deviation according to well-known formula, which includes the weights that we've decided here. Here we create a sequence, so that's a whole range of weights. And we compute the standard deviation for the whole portfolio using this weight from both of the assets. Here, this one draws for us a nice graph that would represent the two asset case. So let's run it. When we run it, we see on the right side the correlation graph. This one represents a graph where the correlation is -1. When the correlation is -1, we can basically diversify away all of the risk until 0, as you can see here, by using different combination of both assets. How is that possible? It's possible because when the return on asset A is 6%, the return on asset B is usually -6%. So it's possible to obtain more of the return of asset A when the asset B would have always the opposite sign. Basically, one asset would hedge the other asset. If we change the correlation to, say, 0.5, we'll see that we are not able to reach the 0 spot on the expected return of 5% with 0 standard deviation. Why? Because now when asset A goes up, the asset B also goes up at the same time because the correlation between them is positive and not negative as it was previously. The sweet spot that we're going to get on this diagram is the one in the left top corner, right here, where the standard deviation is low and the expected return is high. To achieve it, we have to track the range of portfolios and see where and at which point we would be closest to this. And here we would be approximately here on this diagram, as you can see. If the correlation between the assets is 1, it's not possible to use the diversification trick as with other portfolios, because now basically the assets are identical except for the returns that they have and standard deviations. Because when one asset goes up, the other one goes up as well with the same magnitude, which makes our strategy useless. Basically, we should choose the asset which has the best ratio of return to standard deviation, because it's not possible to combine them in a way which would diversify partially the effect of the risk. This line is straight and it's not bendy as before, so we cannot really reach any better combination from both. Now, if we increase the number of assets in our portfolio, how do we do this? We create many assets with the same return, the same standard deviation. All of them are identical and they all correlate with 0.5 correlation coefficient. Now we create a vector of assets. Let's say we have 1000. Here, these are our formulas for computing the return and standard deviation of the whole portfolio as before. And let's have a look at the graph now. It's called the n-asset model. As soon as we increase the number of assets, we're able to reduce the standard deviation as well, because we are able to diversify this risk that I've shown you previously much better, because now we've got a whole range of different assets. So even if they have a positive correlation, which means that basically when return for one asset increases by 1, for the other increases by only half of that, we can still diversify away partially some of the standard deviation or risk from this portfolio and reach this whole asymptotic line on here with the high number of assets. And as you can see, you don't need a huge number of assets to reach it. You need only 10 to 15 and you cannot really do more. So when constructing a portfolio, it's easy to do so by just using 15 assets already. And it already helps you to achieve a better return for a lower risk. And that's what this video is really about. Now, in the second part, I would like you to demonstrate the Markowitz portfolio. It's a well-known model, the Markowitz model, and it's a common way to diversify the portfolio when you're using the real data in your analysis. So, to do so, I prepared a data I call the Markowitz input. To read it, I use the function read.csv2, and I set it to Markowitz input.csv. CSV is like an Excel, it's simply a file. Set header to true and string as factors as false. We are now in the Markowitz model by downloading the corresponding file that I prepared in advance called the Markowitz input. We will analyze it in much more detail, and this file is exactly what you would expect from the real returns that you can download yourself, and we will discuss it in further videos. So let's download this data by running it and then having a look here. Basically, we have a date, and these are monthly returns for several asset classes: stocks, treasuries, corporate bonds, real estate, and money market. What we aim to do is to create a portfolio of these 6 asset classes, which would maximize our total return by changing the weight for each of these asset classes. This is a very clever idea, because what we aim to do, once again, is to maximize return and to reduce the standard deviation of the whole portfolio. Here, a couple of additional commands just to create the respective vectors for each of the asset class that we're going to use, and to change the data time to a corresponding format that R would understand. That's what this command does. In the following, we can just extract the mean from the data from each vector for each asset. That's what mu1, mu2, and mu3 until mu6 represents. We just use the function mean to extract the mean monthly return for each of the asset. Then we can save it into a special vector, multiply by 12 to convert it into the annual return for each asset. We can use the function round to round the necessary decimal places, basically until 4. Then we can use the function cov to extract the covariances of all of these asset classes with one another, as we've already discussed. The covariance is a similar concept of correlation coefficient, except that it's not standardized. What I mean by this is that correlation is typically ranges from -1 to 1. Covariance is expressed not in standardized units, and it ranges from -infinity to infinity because it's expressed in units that we're using for each of these asset classes, or basically the returns, so it's represented in percentages. This sigma vector, or the composition of vectors, a matrix, exactly represents that. If you want, you can have a look at it. By looking here, you can see that the stocks have a negative correlation with treasuries and with real estate. So a good portfolio intuitively would include a combination of both. Because when one is up, such as stocks, the treasuries and real estate are down in the stock market. The standard deviation just converts these variances or covariances into the standard deviation. And that's simply the square root of the covariance, as you can read here. The following code basically uses the Markowitz formula, which is basically the weight W. We set the first weight to 1/6 because we have 6 assets. So 1/6 is the first intuitive trial choice. So you just take 1/6 of each asset in your portfolio, and the total would add up to 1 or 100%. The second line represents the Markowitz formula part, where you take the transpose of the vector of weights and multiply it with the product rule by the returns. Don't mind this too much, but remember this formula would be quite important for further understanding, but you just need to see it once, and then you can use it because it's simply a formula. You shouldn't overthink it. Sigma p simply is another formula that computes the standard deviation of the whole portfolio. MUP and sigma p are the returns of the portfolio, and once again, the standard deviation of the portfolio. Let's run all of this. As you can see, with equal weights, or 1/6, the standard deviation is 0.04, and the return is 0.06 or 6.6%. To optimize it, we're going to try different versions of weights to see which one gives the highest return with the lowest risk of standard deviation. For this, we're going to use the library quadproc, so you can click on the library quadproc to install it. When you write this command here, the install icon will appear on the top normally. So let's try and unconstrain the efficient frontier method for that. We'll use the following code for that, and let's run it. Basically, what happened now is that the optimization happened throughout all of this code. What we can do now is observe graphically what type of optimization is the best. As you can see on this diagram, we try different versions with our 6 asset classes. And there you see different types of combinations at each return of the portfolio. For example, 0.04, the standard deviation is about 0.01 until very high levels of return. The most optimal portfolio should have the best ratio of return to the standard deviation. It's also commonly known as the Sharpe ratio. So the best portfolio for us would be the portfolio that would be almost somewhere here. Let's continue and have a look at the following example. From this, in order to determine the best possible combination, we can just draw a line from here, from the risk-free asset on this diagram, to define the optimal portfolio that we would like to hold. Each of these combinations has a range of weights that we have to find. And here we will use the Tobin's two-fund theorem. One fund is our portfolio, the second fund would be the risk-free asset. Here's our second example, which has another range of the parameters that we will generate. What this does is that it simply creates 30 assets with a certain correlation with each other, namely 0.5, and it simulates the return for each of them. Next, we will create a range of returns for optimization and run the code to optimize the portfolio for us. Now, this code does exactly what we did with the markets portfolio with our real example. It creates this line with different portfolio weights for our 30 assets. Now, in order to find our top return, what we're going to do is use the numerical differentiation to find the point and the weights at which in this diagram we would have the highest return and the lowest standard deviation, or the combination which would be towards the left top corner. Now, to understand what I mean, you can have a look at the graph that uses the Tobin's idea. There is a range of potential portfolios that we've optimized for. However, this portfolio is the best, and the risk-free asset is exactly here. It's called risk-free because the standard deviation of this asset is 0, and it generates a return of about 0.05 or something like that. From this asset, we can draw simply a line along which there are different combinations between this asset and the portfolio that is here, which represents the best possible portfolio that maximizes your return at the lowest risk. To find this one, we can use a numerical differentiation method, which basically finds the top point at which you would maximize the return and lowest standard deviation. Here, now, what you should do, depending on your risk aversion, is to find the optimal combination between the risk-free asset and this portfolio, which represents the portfolio of all risky stocks that we have. We have 30 of them. Now, depending on your risk aversion, you will be able to adjust the level at which you would hold this portfolio with the risky stocks. However, you should be aware that it's already optimized and it would generate the best possible return that you can have in the world of all these risky stocks. So that's it for today. I hope you will like the video, share, and I'll post more in the future. See you.